Traders, Nick Shaheen here looking at FANG. That's the gang that they created on CNBC, I think Kramer was. Basically the stocks that we all know and love: Facebook, Amazon, Netflix, and Google. Now Google is two tickers now. Everybody forgets that. It's Goog and Google. The company is Alphabet. Nevertheless, it's giant mega tech companies. Some are advertising, that's Facebook and Google, obviously. And then Amazon is kind of advertising, growing piece there, but also behemoth in many other verticals. Champion stock, amazing company. And then we have Netflix kind of like stuck in the middle, which it shouldn't be in there. That's my opinion. It's not of the same caliber, nowhere near it. But anyway, it's in there. I'd like to slip in Apple too. So let's look at FANG. I do have, this is Apple, what we're looking at here. I do have I can chart it. This is FANG, not people chart it. And let me take away my notes on it. This is everybody but Apple. We can add Apple in there. Let's see if I can do it quickly here. It's not going to change much, I bet you. There we go. So it's not going to change much. I'm going to take it out. So what now? This is a collection of companies that have incredible P&Ls. So they're reporting well. I'm going to exclude Netflix now. Ignore the Netflix portion in there. They have great balance sheets. Google's balance sheet is unbelievable. I know people talk about Apple's. Google has almost no debt. Relative to Apple, Apple has a lot of cash, but has a lot of debt. Tim Cook took it from zero debt to about 120 billion. Yes, with a B, 120 billion in debt. So yeah, it's cheap debt, but it's still debt. But it's still cash cow, so it's not a problem so far. So every dip should be bought in theory, if you believe the stock market is going higher. In fact, this is a weekly chart. This is over a period of 5 years. If you own them, this is what they did. Let me see. Can I do a monthly chart on this one? So this is over, I don't know. Let's not go there because it's irrelevant back then. But, so dips should be bought on the weekly. Going back to the daily, you can treat them as a regular company as far as the chart is concerned. So they tried to break out to all-time highs several times. So from that perspective, we can discern a few things that, okay, they say double tops. They say there are no triple tops. I have no idea what they mean by that. So there was a top here and a top here. This was the October crash, I'm going to say October correction that ended in the Christmas crash right here. We V'd out of it back to above the accident scene, but not bigger than that accident scene or this one. And then we V'd out of that one here. This is the May correction. And then here we are back to the accident scene. So I'm no genius when it comes to technical. I'm winking at you here, but you can't see it. Okay, so this is one push, another push, and another push, right? What do we have here? One neckline. So you've heard of head and shoulders, right? When a stock does this and it loses the neckline, it falls about as much as this, right? So it falls down to here. When you flip it upside down, the opposite happens. And let me walk you through it in plain, simple English. So this is a quick lesson on head and shoulders and inverse head and shoulders. This is the opposite, right? So this is a head and shoulders. This is inverse head and shoulders. You got one head, two shoulders. And they don't have to be scientifically equal. But the idea is that the bears push it. The bulls say, nope, we can do it. The bears say, nope, go back to where you came from. And they push it a lot further. Look, a lot further. The bulls say, you know what? This is wrong. Let me get back to it. And then they get back to the same battle zone, same neckline. The bears say, I can do it again. And the bears fail. Look how much less they went than this time. Bulls say, I can get you back to the neckline. So clearly, the suggestion is that the bears are getting tired and they're coming back to the same neckline. So theoretically, once they break through that neckline, they're going to overshoot higher by about that much. So the point is, they can do another shoulder and it being a complex head and shoulder or whatever. The bottom line is they're attacking the same neckline. Do it enough times and one of those times will poke over. And once it pokes over, the stop programs kick in. Everybody that's short, they have to cover. And that buying begets buying begets buying. And then we get a short squeeze. Not that these guys are very shorted, but the buying begets buying. There's a panic buy, the FOMO, whatever you want to call it. It's not good that we keep failing at the same spot. So you can argue that point from both sides. You have higher lows here, so that's good. And these are daily candles. I can get smarter and try to get a little shorter term. So now I have, you know, a lower line to cross. And it's hard to say, okay, at 4,800 because it's a bunch of stocks. But you see how the spirit of it is, right? And believe it or not, we can even chart them relative to something else. So let's see how they're doing relative to the small caps, for example. How about just relative to the SPY? So this is how the FANG gang is doing relative to the SPY, the S&P. Right now, they're in balance. This is exactly the point where they're in balance. So there is no advantage to be in the SPY or into the FANG gang. So if you think that they're leaders, maybe they'll make the move. I can tell you one thing. Something is coming. So they're either going to take the lead from the SPY. In other words, we're going to see a big bounce in mega caps, or we're going to see a big dump in mega caps. So keep that in mind. Something is going to happen. Either this, which means that Apple, Google, Facebook, Amazon, Netflix, or all of them is going to spike soon, or this. So keep in mind that we have the AGs after these mega caps. They want to sue them. They want to make them suffer, just like they did with Microsoft. Maybe that's the... What does that mean? It all depends on what's going to happen with the headlines for this particular bunch. Now, this is a relative chart. I may have flipped them here. It doesn't matter. So the point is, relative to the whole market, they are as quiet as they have been all year. Something's got to change. That's my opinion. So if I'm long Google and Facebook and Amazon, I just have to keep an eye on it. But if I'm looking to take a flyer on it and I don't have any longs in it, maybe I'll sell some put spreads in there, and maybe I'll hold some calls. Maybe I'll buy a few positions. I like Facebook just because it's a monster and it's violent. So if I get it right, I'm going to profit a lot. If I get it wrong, I'm going to lose some for a little bit of time. But it's got a proven floor. Great model. I mean, the management scares me every once in a while, but it's going to be hard to mess up 2 billion users. It's going to take a special kind of idiot. Apple is a sleeper. If I'm long Apple, I definitely will hold it. This may be headed to 250. This is a weekly chart. It all depends on what pattern breaks out first. This pattern has been unfolding for a while. I drew it a long time ago and profited off of sharing taking longs and sharing it. So is it done? I don't know. I don't think so. Any tick above that green line and we'll probably head straight there. It didn't happen when I drew it here. Maybe it happens now, but I did draw the white one a while back and it was a slow mover, so maybe this is unfolding. So Apple is a good candidate. Amazon is always a good candidate. And here's the thing about Amazon. It's lagging. Usually it's a leader, up or down. So if markets are in trouble, Amazon should be down here. And if markets are great, Amazon should be up there. But it's neither. So it's lagging the group. So there might be a surprise there. Whether good or bad, it all depends on the headlines. But I like Amazon and I wouldn't dare short it. So if I want to trigger on Amazon, mark this. A move above 1835-ish, let's call it 1840, would get me really excited. A move above 1860, this is a moving target, will get me really excited and maybe even fill the gap all the way to here. As soon as we clear 60, 65, I think the reins will go from the sellers to the buyers. Now, there is a bearish pattern that could be developing that could say, okay, Amazon could see 1620 or 1600 even. But I'm not calling for it. I'm just wary of it. So something that happens like this. Now, this is, again, Main Street interpretation of Wall Street patterns. Eyeball, this happens. This will stand in the way. This will stand in the way. So look, this is nice and neat. Look how neat this is. Right here, right here, right here, and right here. So as soon as this is lost, I stop worrying about this, but I know there's going to be a stopover right here. Okay, so this is the risk with Amazon. The opposite, the good news with Amazon is a move like this. So these are the two opportunities. So here I just rambled off at least 3 or 4 trade ideas, trade setups, whatever you want to call them. Google, squeeze, narrow range. Something's going to happen. Lawsuit or happy days. Look at this. I mean, they don't draw them tighter than this. I mean, hello. Something's got to give. What do I trigger? I go long above this line. This starts to worry me. This is a bug out. So if I go long, I bug out here or here, depends on the personal preference, or here. If I got to here and I didn't bug out, this is where I don't bug out, because this is the point of control. This is where bulls and bears fought it out the hardest. So it's going to create congestion. If Google falls, they're going to step in to buy it right here. So now that I talk about it, Google's probably pretty tight, and it's going to move. When I say tight, it means the range went from, I forgot to do this for dramatics. Here's Google. So this is the range, and now this is the range. Something's got to give. Boop, boop. All right, Nick signing out. You know where to reach me. Oh, if you haven't subscribed yet to the channel, there should be a button up there somewhere. It's free.